So, as I had mentioned, so sometimes they're called pass-through entities, sometimes they're called flow-through entities. These are entities that they report income on a separate tax return, but they don't pay income tax. The items of income and expense flow through to the owners. Now, one of the complications of these types of entities and that income flowing through is that sometimes entities have different types of income, right? So not just business income, but maybe the business has its own investments. Or maybe the business sold some assets, and as we learned in the last chapter, how we pay tax on the sale of those assets is going to depend on a lot of different factors, right? So we have, from these entities, we have several different types of income. All of that income retains its character. And by that, I mean that if we have a flow-through entity that receives qualified dividends, then when that income flows through to the owners, it's going to flow through as a qualified dividend. So it's going to, instead of being mixed in with all of the other income and expenses from the operations, it's going to retain its character. So for example, if, I don't know where the black marker went, but okay. Let's say we had, oh, I don't like that one. I think I brought it back here, hold on. Let's see if this works. Oh, company ABC, okay? And we have, and it's a partner, well, no, it's a company, so we'll say it's an S corp. Doesn't really matter, whatever. This doesn't work either. Let's see if the green works. And we have 3 owners. Owner A, owner B, and owner C. And owner A owns 20%. Owner B owns 50%, and owner C owns 30%. Okay. Company ABC is going to file a tax return on an 1120S, and it's going to report all of its items of income and expense, and it's going to have net income. All of it's going to flow through to these owners based upon their ownership percentage. But let's say that company ABC had net income from operations of $100,000. But in addition to that, the company also had some short-term capital gains of $1,000, had some long-term capital gains of $1,000, had some qualified dividends because it's got investments of $10,000. I'm making these nice and easy to calculate on my calculator. And it had a section. It used section 179 on $10,000 of expenses. Now remember that section 179 is going to be limited per taxpayer. Remember we had those limits. That limit is per taxpayer. So this section 179 deduction is going to flow through to each of these partners based on their partnership percentages. Remember the long-term and short-term capital gains, we're going to net those with other long-term and short-term capital gains, but that netting is done at the individual level. So if partner A has some losses, they're going to be able to offset some of those gains that come in from this S corp, right? I'm using the word partner. I'm sorry. It's a partnership. We'll say it's partnership. Doesn't really matter, but just because I keep using the word partner. All right. So they're going to have ordinary income each of these partners, 20% of the 100,000, 20,000. Partner B, 50,000. Partner C, 30,000. Partner A is also going to have some long-term capital gains of 200, 500, 300. Some short-term capital gains of 200, 500, 300. And each of them will get some Section 179 expense that's going to be combined with any other Section 179 expense that they may have from other, maybe they've got a Schedule C on their income tax return, maybe they own other businesses and they've got some Section 179. All of that's going to flow through to their return, and that limit is going to be based upon their return, their individual return. In this case, okay, 2,000, 5,000, 3,000. All of that is going to flow through then, and it's going to combine with other items on their tax return. Now remember, as I had mentioned earlier, you know, if owner A is in the, I don't know, 22% tax bracket, then that's going to be taxed at 22%. Now, whether or not these long-term gains are taxed at 0% or 15% or 20% is going to depend upon the other income on partner A's tax return. Same thing for each of these partners. If partner A has other long-term capital losses of $500, say, it's going to get to offset $200 of that, and also the short term. So 400, so they'll only have $100, or they'll have $100 of capital losses overall. Carryovers, this gets added to the totals for those carryover amounts as well. So if these were losses that would get carried, it could potentially get carried over to another year if they had other amounts that exceeded the $3,000 limit. These are called so this is our ordinary income. All of these are referred to as separately stated items. Other types of separately stated items: rent income, royalty income, any type of income that is different from what would be ordinary income, okay? And it's going to be reported on a form that's called a Form K-1. I'll show you what that looks like. And all of these things are already, they're separated out on the K-1. So when you're filing a tax return with somebody that has a K-1, these items are probably going to go in different places on their personal tax return, not just one place. Now, most software packages will make it pretty easy for you, and it'll have one form where you enter the K-1. I think your tax act probably has that, where you can just enter it on the K-1. But then if you see, there's not like a one place where this income goes. It goes all over the tax return where it belongs. So this is going to go on the second page of the second page of the Schedule E. This is going to go on in 8929, and then to the Schedule D. This is going to, same thing, 8929, then the Schedule D. This is going to go on the 4797 form, right? This is going to go, it's going to be entered probably directly on the, well, it goes on the schedule, I'm sorry, the Schedule E, but then it flows through to the Schedule 1. So all of these items, like I said, they get dispersed about the tax return. Okay, let's see, Schedule K-1, as I mentioned here. Partners' distributive share of income, expenses, or losses. They report the income and loss from their K-1s in Part 2 and Part 3 on the Schedule E, but like I said, these other separately stated items go in different places on the tax form. Other types of entities, so I had mentioned, so partnerships, S corporations, estates, trusts, those are all considered to be flow-through entities. They have some sort of beneficiary that is receiving it. Now, it's always going to be more than one. except for estates and trusts, it could just be one person. But when we're talking about S corporations and partnerships, it's gonna be, well, I shouldn't say that. If it's partnerships, it's always gonna be more than one person. S corps can just be one person. Now, your book also mentions limited liability companies. Limited liability companies are legal entities, they are not state entities. So they are organized by the state, within the state in which the company resides. An LLC could be a sole proprietorship, it could be a partnership, it could be an S corporation. Those are all tax entities. But the majority of those LLCs are probably gonna be S corps or partnerships. So they are probably mostly going to be pass-through entities, but not always, okay? So just know that that LLC, there is no tax entity called an LLC. That is a legal entity, okay? Let's see. Okay, so this income could be, it may be subject to self-employment income, or it may not. If the individual is providing services to the company, then it's considered to be active income. It would be earned income and therefore subject to self-employment tax. If, however, they're just an investor, they just put money in and then they're getting payments out of it, then this would be considered investment income, okay? And the tax treatment of that is going to be different as well. Let's see, what else do I want to say here? As I mentioned that here. So typically a partnership is either an active trade or business or a passive activity. Passive activity usually involves an investor relationship, whereas a partner materially participates in an active trade or business. Example, Dave's a partner in a CPA firm. He works there full time. He's also a partner. So the income that he receives that is reported to him on the K1 is going to be subject to self-employment income because he is active in it. CPA firm partnership is an active trade or business. Real estate partnerships, he is also an investor as a limited partner in several real estate partnerships. But in that case, he's just an investor. So that partnership income would be considered investment income, whereas the income from the CPA firm would be considered active trade or business and subject to self-employment tax. Okay, so it has to do with how the activities that he's providing, and what he's providing. Is his money working or is he working, right?
So, excuse me, so K-1 is only partnership.
Well, K1s, partnerships, and S corporations, and estates and trusts. Anything that's a pass-through entity or a flow-through entity would have a K1. They're gonna look different though. And you're gonna see in chapter 14 and 15 when we're gonna look at those K1s. The K1s are slightly different. They're not a lot different, but they're slightly different from each other.
Yeah, because I'm seeing K1 S and K-1. K-1 and K-1S.
K-1S is just plural, more than one K1. So when you see that, where did they do that?
Here,
Where is it?
line 3.
Right here. The K1s, that's just plural, more than one K1.
Oh, okay.
Yeah, it's the same form, they're just, K1s from, and again, this isn't a tax entity, but S corporations trusts are similar in appearance to the partnership K1, okay? It's just K1, but more than one K1 is K1s. Does that make sense? Plural.
Okay.
Multiple K1s. Same K1 though.
So this I want to
This
understand.
isn't, K1S is not a separate form from K1. The form is K1. But if there's more than one K1, then they're K1s.
Okay, so
Yeah.
partnership, S corporation, everything is K1.
They receive, the partners, the members, the owners receive a K1. from these entities. If somebody just works for the entity, they're not gonna get a K-1. Like if you're an employee of a partnership, but you don't own any part of the partnership, you don't get a K-1, you just get a W-2. Because you're an employee of that partnership. But if you're an owner of the partnership, you're gonna get a K-1. Okay? One other wrinkle, I don't know if they talk about it here. So these items of income, like I said, $100,000 of income and these long-term capital gains in section 179, this is income that's reported, but it's not necessarily income that they received. It doesn't mean that these partners received that cash. They may not have gotten anything, but they're still gonna have to pay tax on their share of the income. Eventually, hopefully, they will receive something out of it. But oftentimes owners don't actually take any, we call them distributions. These payments, if you're an owner and you're getting money out of these entities, that's called a distribution. And it does not always correspond with the income that's reported. In fact, most times it doesn't. It could also be that partner A had $20,000 of ordinary income that they had to report, but they received a $50,000 distribution. That's entirely possible. They still only have to pay tax this year on the $20,000. Okay, so because the distributions could be from income, they could be a return of capital, like they originally invested that money and they're just getting it back. So in the life cycle of the partnership, internally, they keep track of each partner's basis. So we're gonna go back to basis again. Now I'm getting a little ahead of myself here because we're gonna talk about this in chapter 14 more. But just to kind of give you a preview, each partner has a basis in their partnership share, okay? So, and that is tracked on a continuous basis. I use the word basis to define basis, but, all right. So, like I said, there's ordinary income, and then there's separately stated items. All of those items that would be reported differently, right? Also, that QBI, you can claim the QBI for partnership income and S-corp income. So it's pass-through income. You can also claim that QBI for. Here I already kind of talked about this, but we can go through it. So why are different types of income and expenses from a partnership separately stated? Why not just lump them all together and have one income or loss number from the partnership? Any item that could be treated differently by different partners is separately stated. Also, partners aren't necessarily always individuals. It could be another company that owns part of the partnership. And the tax rates and tax rules are different for companies than it is, or for corporations than they are for individuals. So one individual partner might have capital gains from other sources to offset capital losses from the partnership, whereas another partner might not have any capital gains and be limited in the amount of capital losses that are allowed. Another example concerns a corporate partner who receives dividends. So we're going to talk about this later too, this dividends received deduction, that's chapter 15. So the dividends are treated differently for individuals than they are for corporations. So, but individuals can own partnerships and corporations can own partnerships as well. So when it flows through, it's just taxed at their own individual, based on their own individual circumstances on their tax return. Charitable deductions are another example. Like businesses can have charitable deductions as well. They could give to charity, but remember, charitable deductions, you're only going to get a tax advantage if you itemize your deductions, right? So if we had some charity, let's say we had some charity of $10,000, so that would be a deduction. 2,000, whoops, 5,000, and 3,000. Well, if partner A who's married filing jointly, has a total of $12,000 of itemized deductions, including the 2,000, they're not gonna itemize their deductions, so they're not gonna get to claim this anyway. They're gonna take the standard deduction. Whereas maybe partner B has $50,000 of itemized deductions, so that $5,000 is gonna help them out. It's gonna help to reduce their income, or their taxable income. Right, so that's gonna be treated separately as well. I want to show you what a K1 looks like. We're going to talk about this, the separately stated items. Okay, so let's talk a little bit, I'll get to the K1 in a second. I do want to talk about, and this only pertains to partnerships, what I'm going to talk about here, okay? Guaranteed payments. So when a partner also provides services to the partnership and gets paid for it, because it's entirely possible that a partner will provide services and not get paid for it, but if they get paid for it, that is not considered wages. It's considered a guaranteed payment. If it's in the form of a salary, so for example, I have a partnership, I don't know, I bake cakes, and I'm in partnership with Shelby here, and you know we both contributed to the partnership. We're both providing services to the partnership. I'm receiving $12,000 a year from that partnership. Whether or not we make money, that's my salary, because I'm providing the services. We'll say she's just an investor. Okay, I'm doing all the work, so I'm going to get paid for my services. I get $12,000 a year. I don't get a W-2 for that. I am not an employee. Owners of partnerships are not employees. They're partners. But if they receive a salary for their services, it's called a guaranteed payment. It's different because that guaranteed payment is self-employment income. Okay? So it is, because a partnership is just like a sole proprietorship, but with more than one person. And so if you had a sole proprietorship and you took out money from that you paid essentially any net income that you're getting from that sole proprietorship, you're paying tax on, and it's subject to self-employment tax. So the same thing is true of partnerships. Partner is not an employee of the partnership, cannot have a deductible salary to the partnership. So that guaranteed payment is not deductible to the partnership. A partner can receive a guaranteed payment for services. The guaranteed payment reduces the ordinary income of the partnership. It is not a salary. The partnership does not pay Social Security tax on it. However, the partner does. The partner must consider the guaranteed payment as self-employment income. From the partner's point of view, the details of the self-employment calculation are unimportant. We don't really need to, I don't know why they even put that in there. So it's, like I said, it's not a salary. It's a guaranteed payment. It's going to be subject to self-employment tax, just as though it was a sole proprietorship. Okay, this is what a K1 looks like. You'll see ordinary income up at the top, box 1. So that would be this amount here, these amounts. Each partner gets one of these. So we've got up here the partnership information and then the partner information. Okay, so each partner would get one of these. Partner A, B, and C would each get one of these. Ordinary income, box 1, that's this top line number. Rental or real estate income, if there is any, or loss. Other rental income, guaranteed payments for services. So if this partner did receive guaranteed payments, it would be reported there. Interest income, so if there was interest, maybe there's tax exempt interest income. And if you're also receiving Social Security income, now you've got to figure, okay, I got to add that back in doing my taxable Social Security calculations. Ordinary dividends, qualified dividends, royalties, short-term capital gain or loss, long-term capital gain or loss, all these things, remember, unrecaptured section 1250 gain, that 25% tax, net section 1231 gain or loss, any other income, here's our section 179 deduction. Other deductions, I think this was a charitable contribution, so there's like a code over here to indicate what that is. Over here, we're given the percentage that this partner owns. So, Jose owns 40% of this partnership. These are his items of income, and loss that are reported based on his 40%. Okay? Don't worry about this. This has to do with the basis calculation will include certain items of debt that the partnership has. Don't worry about that. Let's see, is there anything else here? Nothing else on this one. So what I want you to take away from this mostly is that ordinary business income is separate. Any of these other items are also listed separately on this K1, and then they're gonna go be placed in different places on the 1040, right? This is where it all goes. So this is page 2 of the Schedule E. You see it up here, Schedule E, page 2. Income or loss from partnerships or S corps. The W&S woodworking. Enter P or S. Is it a partnership or is it an S corp? If it's estates and trusts, they go down here. That's why there's no code up there for estates and trusts. If it's a foreign partnership, there are some special rules for that, so you'd have to check that. This isn't the EIN there, and then down here, line A, our corresponding income. So this is just our ordinary. So the 7,600 is our section 179 deduction. That has to go into on this actual form here. Section 179 expense deduction, 7,600. That was on the K1. Again, each individual taxpayer has their limits, their own personal limits on that section 179. So that's why we've got to separately state it, because we're going to combine that with all of our other businesses that we have. Non-passive income from Schedule K1, that's the 2130. Now this is also subject to self-employment tax because he is active in this partnership. Okay, he actually provides services. That was the 2130. That's what goes then here. Okay, these two get combined. So that 7,600, it is limited, and that limit is calculated on the 4562, and then it's carried over to this form. Okay, but that then can offset the ordinary income. So he's got a loss of 5,470, which gets to offset other income on his tax return. Let's see. I already talked about that. Income from, so it's only the partnerships where that income is considered to be self-employment income. S corporations, it's not considered to be self-employment income. S corporations, the owners can be employees. They would receive a W-2 just like any other employee, but they'd also receive a K-1 from the company. Okay. Let's see. Passive, we're not gonna, if it's passive, it would be combined with any passive activity, gains or losses. That's in chapter 13. We don't cover chapter 13. So how do you tell if they're active or passive? There's a box. If it says general partner or LLC member manager, that means they're active. General partner. Limited partner means they're passive. Let's see. That's what that says here. Ordinary income. So this one would be false. Number 2, ordinary income from all flow-through entities is considered self-employment income. No, only partnerships. That's if you're actively participating, if you are a general partner.
So,
That's, mhm.
if I want to ask you, the maximum income passive, the maximum, so it's how much?
There's no maximum passive income. Like, what do you mean?
So maybe you have a 3-year partnership,
Mm-hmm.
so everybody have limit.
Mm-hmm.
So nobody have maximum? Or
No.
Oh, okay.
No, sky's the limit.
Okay.
Make all the money you want.
Okay. Yeah. It's okay.
Let's see. So this one's true. Partners, shareholders, and owners must report the income and loss from the K-1s they receive on Schedule E of their individual tax returns. That's true. It's going to be on the second page of the Schedule E. By definition, rental properties are passive activities. However, in certain cases, a taxpayer may deduct rental losses subject to limitations. That's true. That has to do with the passive income and losses. Now, it could be active if you are a real estate professional as well. Flow-through entities allocate an appropriate share of the entity's income, expenses, or loss to their partners, shareholders, or owners on Schedule K-1. That's true. That's essentially what we just talked about. All of it. Questions? We're going to talk a lot more about partnerships. Well, chapter 14 is partnerships. So, and it's hard. Partnerships are hard, conceptually. There's a lot of really strange rules with regard to partnerships too. But there are a lot of partnerships out there. A lot of businesses that need people to help them with partnerships.
Yeah, so you can expand this line in case for rental activity.
Oh, in cases of rental activity,
Yeah.
however, a taxpayer, this has to do with the passive income and loss limitation. So it's the loss limitation. It's not really I think they call it income and loss limitations, but there's really no limitation on the income side. It's just the loss side. So if it's a rental activity, you can take up to $25,000 of rental losses, net rental losses, but there are AGI limitations to that. So if your AGI is over a certain amount, then you can't take that loss. You have to carry it forward. Yeah. But like I said, chapter 13 deals with that, and we don't really do anything with that. We don't have time. Other questions? No?